welcome to this session with me, Ross-rfx. We're going to be walking you through this setup today and the principles of the concept, how we trade on a daily basis, and how we get our bias overall. Generally, we're just going to give you a really nice in-depth walkthrough for this. So guys, let's jump straight into this. We are going to start off by giving you a concept overview so you have an idea of what it is that we're exactly doing on any given day, because it's okay saying, you know, this high, this low, this POI, etc., without having the core concept presented to you in the first place. You're going to struggle to grasp the reasons why behind it. Okay, so the main concept is we are always focusing on price action delivering in a certain direction. So in this case, delivering down. Then we are looking for price to go against that delivery direction and present a new direction for us. Now, the reason why we do this is because of a couple of different things, and we're going to go into detail as to why we look for this. So number one, the market is manipulated by large institutes and essentially banks. So we have to look out for where their orders sit. Now, how do we recognize large banks getting into the markets at any given time? We recognize it because they produce large, unbalanced and imbalanced, unfulfilled areas within the market. Now, you're going to see those because they're going to break structure, they're going to leave fair value gaps, they're going to leave very obvious clues for us sitting around that we can begin to focus in on and capitalize on when price returns to that point. Now, why would we be interested in capturing these inefficient areas that the markets leave? Well, the basis of this is because when we see a manipulation, so in this case, a run of a low into a break of a high, we understand that this section of price right here holds bank orders. How do we know this? Because it's being manipulated. Prices are being shifted from downwards moving prices into upwards moving prices, telling us the probability of large bank orders sitting in these areas is very, very large. Okay? Very, very large. So, when we have this understanding and bias, we need to develop a story behind what the investments are within this given movement. Now, every single price action movement in the market is based off of an initial investment, which is going to come from a high or low in a certain area. And when they show their hand as to where the investment is going, so aka the same thing happening, a run of a low, or in this case, a run of a high, into a break of a low, we understand that this investment is showing itself again here. How do we know? Because they are manipulating the market into changing the direction. So we went from bearish into bullish, and now we're going from bullish into bearish. So we know that there is another area of manipulation. When we have our point A, so in other words, the initial investment, and point B, we know that point A is where we want to enter. We know that point B is where we expect price to go to. There's only one point missing from this investment. It needs to have surpassed a previous investment that has also manipulated the direction in the market. So we want to see the same thing, a run of a high, for example, a breakdown of a low. And we want that high where the investment was given to be ran. Why is that? Because then we know that the market is running in the same movement that we'd expect from a trending market. So that is, for example, running of each high, producing a new area of liquidity, running of the high, producing a new area of liquidity, running the high, and giving us that trending movement, right? So then all we have is a very clear, I'll get rid of this, a very clear breaker structure, a low of a range, a high of a range. The only difference is we know that there has been strong manipulations in these areas, so we can begin to capitalize on that. So what are we doing once we found the high of the investment and we found the low of the investment? We've confirmed that we can say this is a true investment because we've broken a previous area of manipulation. all we need to do now is work out where the orders are sitting and where the unfulfilled orders within this range lie. So it's very simple. We are going to follow back the inefficiencies in this range. So for example, inefficiencies are untapped order blocks, unmitigated areas of imbalance price, so fair value gaps, imbalances, all of those things. And we're going to follow them back to the very end, okay? And where the fair value gaps, imbalances, and inefficiencies finish is where we are going to locate our order block. So in this case, purely for example, we have located our order block. Now the reason for this is because when this large sum of money is put into the market, they do not have enough time to fulfill the market one-to-one, okay? Now the reason they don't have enough time to fulfill the market one-to-one is because we aren't meeting the criteria for price to tap back into these direct order areas. So what we're looking for is a 1-to-1, right? 1-to-1, which means one buy to one sell. So price will tap into a buy, tap into a sell, tap into a buy, tap into a sell, so on and so forth. But when you have, for example, 1,000 of one order and 1 of another, there will be orders that are left unfulfilled. So for example, right here, the orders are left unfulfilled, which means that the orders still sit in this area. And the whole time that we're playing within this range, these orders will remain. So what we look to do is we look to capitalize on the reinvestment of large banks by placing our unfulfilled or currently unfulfilled order in the same area as theirs. So when price does come back down to fill that gap in the market, we get our orders filled as well. Okay? Once our orders are filled, it's a very simple job. We simply follow the structure that brought us down, and we will look for areas that we can partial out of our trade, break even on the trade, but overall our price target will always be the investment high. This is based off of the same principles as any trend. Downwards trend, upwards trend, obviously not ranging because that's not a trend, but the same principles apply. In an upwards trend, the highs will serve as liquidity. In a downwards trend, the lows will serve as liquidity. And all we're doing is allowing the external trend, so the larger trend move, be the defining factor in where we are aiming for price to go. We're allowing the sub-trend or the internal structures / internal trends to give us the area and the precise location to enter, but we're always following the larger agenda, which is to run a high in an upwards trend, to run a low in a downwards trend. So now that we've covered the core concepts, we're going to go down and actually show you this setup as a whole. And we're going to walk you through what we saw at the time and how we were able to capture this setup as a whole. Now, during the live stream, for anyone that watches back, I did have a small moment of doubt where I spotted this small structure piece here in the middle, which actually made me question if I had correctly highlighted my swing structures. But it was only after looking at it once, looking at it twice, and discussing with you guys that I'm just going to reduce my risk, that I stuck to my guns and said, you know, this is my rule set. I may have deviated slightly from it, which I didn't. It was just a case of, again, we'll go into this a little bit more in a second. So if anyone was confused during the live stream, I do apologize for that, but that was just me not being 100%. And I'm quite anal with overall every kind of setup that I get into. I want it to be perfect. So if there is a doubt in my mind, I will reduce my risk immediately or just won't even trade it at all. So first things first. What we had previously within this move was a very large range. Again, we had bearish order flow into bullish order flow. And this is where our high was produced because we had bearish order flow delivered again. Now, in this case, this high was ran. And overall, we produced a new range. So when we run a swing high or low, we know that it's producing a new range because it's wiping out a previous investment. Now, we had several candle closes above this, so we know that this is a pretty strong close. So all we did was we followed the structure that we have, which is bullish structures. All of these structures are bullish. Yeah. We followed the lows until we find our last low point, which is here. And we find our last high, which is here. Now at this time, or sorry, if I rewind it slightly, at this time, we had no swing high created, so our range was not complete. All we had was a 5-minute low and a 5-minute high. So at this point, we would have still expected price to deliver bullish. Okay. Now, the only thing that is going to define this high is if we break a structure in the opposite direction. Now, of course, like I said earlier, we know that we were bullish at this point. So we're just going to wait and let this structure break happen. When it does, we can then start to confirm the high being produced. So we'll mark that up. And until we get a solid candle close below this level, we are not going to be interested in trading this. And right there, you can see we have 1, 2 body closes below, successfully creating our swing high. So at this point, we now need to locate the other half of our range. Remember how we discussed this in the principle section that we went over at the very beginning. When we've created a swing high, we know where the end of the investment is. We now need to find where they first invested. Okay. The reason we do it in this way is because if you find this end first, you can easily put in a new low above and become, how would I say, closed off to the idea that this is not a relevant low anymore. And you always hunt for this to run back down to here, when in reality, you know, it should only be running to here, for example, and then pushing high. Yeah. So again, that's for a different session. But based off of this, we're just going to follow price action back now. And we're going to find the point where we were breaking structures against this direction, which is up. So we can see down here that we did test this, but we didn't close below. Again, no closes below any lows here. Consistently pushing higher and creating new highs. And even at this point here, we had a high right here, which didn't actually get broken until this point. So based off of that, and based off of the understanding that we have here, we would expect price to continue moving higher, yeah? So when we follow this back and we say to ourselves, okay, well, this is bullish, this is all bullish, this is all bullish, we keep looking towards bearish breakdowns. Again, bearish breakdown, bearish breakdown, bearish breakdown. So we can now say to ourselves, okay, well, the lowest low from the bearish to bullish movement is where we're going to look for price action to return to. And when price action returns to this area, we are then going to look to fulfill the orders. Now, what do we have to do first before price gets down to this level and before we begin to look to trade this? We need to locate where the orders lie. And we locate where the orders lie by finding the inefficiencies, like I say. So we can follow it back from the high if we really want to, but realistically, we can go to below 50% and start from there. Anything above the 50% of a given range, we're not going to be interested in anyway. Again, discount premium, we'll get into that in another session. It's not a very hard concept to understand. Simply measure the low to high of a range. Anything above the 50% is not going to be valid to trade from. So we can see that we have a POI right here at the base of this move, which clearly has imbalance above it. And we can clearly see that that is an inefficient move because it has not been tapped back in. We can also see that we have a very small, not small, sorry, but well, yeah, a reasonably large candle, but a very small gap in between here and here. But this has been tapped back into by this, so we know that that is efficient. We can see that we do have a small level of inefficiency here, so in other words, a fair value gap, and we have an unmitigated candle at the base here. We also have very large candles coming out of this move, telling us that this is a very key area, and we may have some large orders sitting here. We know this because of the way the market's moved. We know this because it's unfulfilled, meaning that there is probably going to be a large amount of orders sitting here. Now, once we've found our POI, all that's left to do is add confluence to this POI and essentially dictate to ourselves where our parameters are. Now, the parameters of any trade are going to be the same. It's going to be, where's your stop loss going, where is your entry going, and where is your TP going. Now, the reason I did it in that order was because it's okay to have an area like this and say, I'm going to enter here. But if you don't know where your stop loss is going before your entry, you will enter here, price will travel down, and you'll go, oh, actually, there's equal lows here, for example. It will tap the equal lows, push off, and you'll go, oh, I wish I'd have looked at that first. So always, before entry, look where your invalidation is going to be. Your invalidation point is going to be more key, if not just as key, as the entry. Because if you have a good entry but a bad stop loss, you're going to get stopped out. If you have a good entry, a good stop loss, it's going to work out a lot better for you, right? And then only once those two have been established can you begin to look for your target. Now, in this case, the way that we're looking at this price chart and the way that we're managing our trades and the way we're analyzing the market, our target is already given to us before we get into the trade. So that side of it is covered. Now, what we're always going to look to do is put our stop loss below our swing low. So in other words, the point where we went from bearish to bullish price action. We're going to look to put our TP at the point where we have gone from bullish to bearish price action. This is obviously, of course, only relevant for a bullish range. And then we're going to look to enter at the last unmitigated area of orders, or your last order block that is unmitigated. Again, you can use this system with fair value gaps, whatever you like, whatever you use to get in and out of trades with, use it. Okay, I'm not telling you have to do order blocks. For me, I trade order blocks. I trade the inefficiencies as order block indicators, if you were. So I'm not going to trade off of a fair value gap. But again, that's just down to me. Now, the only thing left to do is wait for price to deliver internal structure. Now, why is this internal structure important? Number one, we want to see corrective price action. So we want to see price action that moves very efficiently. In other words, order filled areas being tapped in and then delivering lower, aka taking out the lows, downwards trend, for example. Again, we want to see more order areas being tapped in, price traveling down. Again, it doesn't have to be super efficient. We just don't want to see it travel straight down like this, because that is more of an expansion or an aggressive price action movement. Whereas that tells us the investments may have changed and they may not be on our side of the market anymore. We want to make sure that we're seeing price delivery to this point being efficient, less aggressive, and more of a corrective price action than an expansive price action. Because when we have an expansion, it normally means it's aiming for a target or it's hunting something. And we don't want to be the thing that's being hunted, right? So let this play out, and then we'll talk about the price action that we have here overall. Again, you can see already very nicely high order area. You can see there's orders because there is imbalance. Price comes back, taps in, expands lower again. Let's just play this. Again, order areas sitting around here. We want price to tap back in and drop lower. Taps back in. There we go. Sweeps it. Drops lower. Okay. Now at this point, what have we done? We have built extensive amounts of liquidity along pretty much since the creation of the swing high that people are going to be following. People are going to see this and they're going to go for the sell side. Now, why is this important? Why does this matter? The reason it's important is because the more sell side involvement we have within a bullish range means the more money is being generated in the wrong direction against this overall market movement. Now, again, sometimes you may see very clean trendline price action like this and then price actually go bearish. You may see that. But again, like I've said before, a 50% hit rate with a system like this is more than adequate. 50% hit rate is amazing. Like that is more than adequate. You don't need any more than a 50% hit rate. And if you do have more than 50% hit rate, then you're absolutely laughing. You'll be passing funded challenges day by day. But again, regardless of that, when we see liquidity building up like this, it tells us that, okay, you know, there's obviously orders sitting around these areas. There's obviously stop losses sitting around these areas. So when we do, or if we get a tap into here, we have a narrative for price to want to hunt this internal liquidity, not including the external liquidity that's being left for price to run up after it's been efficient within its range. Okay, so the other confluences that we can bring in with the price action internally, so the pullback price action or the corrective price action, if you were, is liquidity being built towards our entry area. Now, in this case, you can see that people are more than likely going to spot this and they're going to look to buy in because we have trend line. We have a low here. We have a low here. You know, we've broken a short-term high here. People are going to be getting excited thinking that this is time to buy. So we call this inducement because it's early buyers are going to get swept out of the market. Now, if we watch what happens here, remember what I've said before, guys. When you have liquidity in given areas, whether the liquidity is above here, whether the liquidity is below here, you're going to see quite aggressive expansions through that. Not all the time, but a lot of the time you are going to see quite aggressive expansions through that. So look at price and work out where it's expanding and you'll see where the stop losses are. See the large expansion past this low people are trying to buy from. Again, an aggressive expansion past this low people are trying to buy from. Now everyone's selling. So where are your stop losses? Here, here, here. Remember, what they want is everybody to be on the wrong side of the market. Yeah. Now, at this point, we get a tap in, an immediate rejection. Now, for us at this point, we know that the order flow is bearish. It's brought us down into this area. So we are going to locate our closest 5-minute high, and this is where we are going to look for the order flow to change. Okay. Now, in this case, the highest, not the highest, sorry, the nearest 5-minute high is right here. So how price reacts when it gets to this point is going to dictate to us whether order flow is changing to bullish and we can look for price to run the high, or whether it's just going to come up, reject away and continue going down. Again, by this point we were, I believe, 1 to 2. So we'd already 2% in profit if you're risking 1%. You have the ability to go break even if you want to. You have the ability to cut off some of your position if you want to. But overall, we're just going to look to secure at least our overall risk. We're going to mitigate that risk. But again, watch how price plays out here. Again, the immediate rejection telling us that there is still orders in this area and that they are being deployed. And again, you'll see very clean price action, and then we get an immediate push and close above. Now, notice again, what did I say earlier? Where are the stop losses? When they ran these lows, where are the stop losses? Well, the stop losses above this high here, stop losses above this high here, stop losses above this high here, above this high, above this high, and above this high. So watch how price behaves when it gets to those points. Let me just rewind this for you. Watch how price behaves when it gets to these points. Remember, if your stop loss is in an area that's going to be targeted, they will take it aggressively and quickly. Why is that? Because they do not want you getting out with a profit or with a break even. They want your money. So how are they going to come for it? Quickly, fast and aggressively. Okay, watch price right here. Bang. Takes everybody out that's within 4 or 5 pips of this. Maybe not 4 or 5 pips. Let's see. Yep, 5 pips. Everyone within 5 or 6 pips absolutely getting demolished there within seconds. Also, if you're running like a 1 pip spread, you probably are going to get slippage on that anyway. Again, price consolidating and then slap, taking out all of the stop losses in these areas. Yeah. Watch how price continues to behave here. Again, sweeping these highs aggressively. Pushing back down. Why is this? Because all of these people that got stopped out around here begin to load up the high because they believe now is the time to sell off. So you'll see price play around a little bit and then watch how price reacts when it gets to this high again. Again, playing around, bang, straight away. So plays around, encourages them in, and then slap, takes it straight away. Again, this is very, very clean directional displacement in price here. And overall, you can see that this is the clearly corrective price action. This is clearly where the new orders are coming in. and we would only expect price to run this high unless it decides to reverse. Now, of course, today we do have the FOMC coming up this afternoon, so we may see a complete trend reversal, but we're secure in this. We've taken partials. We are looking to just let this run to TP now. I didn't enter with a large enough position to partial out too much, so there wasn't a huge amount of options I had with this. But safety first. Again, I would have entered with a full position, but I kind of messed up myself when it came to not double checking the range in the first place. So again, one of those things, we all make mistakes, we're all human, especially when it comes to technical analysis. It can be very wearing and fatiguing on the mind. So for now, I'm not sure where we are exactly, but I'm still looking for this to run the high here. Let's just play this. Still looking for this to run the high within this larger range. Now, we have dropped down significantly into this lower area, but if you think about what we're seeing right here, we have an area right here that price has left orders. Again, we can see this because we have the same thing happening. If we just reduce this down, we have a bearish price action into a bullish price action. So we can reduce this down because we know we've taken this high. And we now have bullish price action into bearish price action because we've taken out, again, this low. So we can highlight this as a short-term swing high. This is our short-term swing low. And we would expect price to tap into this to go bullish. Now, again, news is coming, so I'm not going to expect price action to be super efficient. Remember what I've said before, when the price action is being inefficient and then it is being efficient for us to trade it, you can't lean on both sides. You can't lean on the inefficiency of the market whilst also leaning on the efficiency, because the probability of that working for you both sides is going to be a lot less. Again, if this goes break even, so be it. We know by consistently applying this rule set to the market, you are going to see price action play out consistently in your direction. Even if you only use the swing low to swing high as a directional bias, it's always going to give you consistent results as long as you apply your system to it and you consistently follow what you have. Now, in this case, if you were to enter this trade, you could have managed this in a multiple different ways. You could have managed it in an RR basis, so your risk reward, depending on what level of risk reward you get to, depends on what percentage of your trade that you cut off, what percentage you're going to be partialing out of, etc., etc. For me, I like to do it on a structural basis because this gives the actual trade a bit more context rather than using an RR, because every trade is different. At least with structural confirmations and structural management, you're using short-term investments in the market to manage your overall larger position. So what you'd be looking for at your entry is your nearest points of structure, and as long as they aren't too closely knit together, you will be looking to close out partials at each point. Now, how much you partial out is going to be up to you. Again, it's going to be dependent on position size, personality, the pair. It's going to be dependent on lots of different things. So just find your structural points and look to manage based off of that, or set your risk reward levels that you want to trade, you want to partial out of, for example, and then follow those. But as long as you consistently apply the same rules, you consistently do the same analysis, and you consistently enter when the market's telling you one thing or your analysis is telling you one thing, then I can promise you all now that you will see consistent results. Okay? Massive tip for anybody that is struggling: cut your pairs down to like 3 pairs. Okay? 3 pairs, and understand where they are in the market at any given time. So there is none of this, I'm not sure where this is going, I'm not sure where this is going, I'm not sure where this is going. You will always have a swing range, whether it's bullish or bearish. You will always have a POI that you want to trade from. You will always have an invalidation and a validation point. Okay? So really think about it and cut down to the pairs that you trade the most, because you will see a huge improvement when it comes to tracking individual pairs, rather than trying to find swing ranges and trade them on, a million different pairs. Following day by day 3 pairs that you really do like, or even 4 pairs, as long as you can manage to analyze them all day by day, you're going to be able to consistently catch very, very highly profitable trades. So remember, guys, 50% hit rate with a system like this is adequate and more than enough So do not expect every trade you enter to work, but always know that if you lose one, you will eventually win one. And when you win one, you're more likely going to end up losing one. It is part of the way that trading works, and it's all going to be down to your mental mindset. So guys, I hope this in-depth walkthrough of this trade setup has helped you all understand the core concepts, the actual principles and rules that we use, and the application of this, what it can provide for you if you do essentially keep applying it properly. So guys, as always, I've been your host. If you haven't already, hit that subscribe button, hit that like button, and I'll catch you all in the next one. Peace and love, guys.